For years, luxury fashion houses could raise prices at will, often by 20 to 40% on iconic bags, while buyers barely flinched. Behind the glamorous storefronts, something has cracked. Younger shoppers are pulling back, and brands are quietly discounting what was once untouchable. Inventory is piling up, and resale values are collapsing for mid-tier brands. The rules that protected the aura of luxury are breaking apart. If prices are dropping in a world built on scarcity, what does that reveal about the future of status and who decides what counts as luxury now? In boardrooms from Paris to New York, luxury executives spent the years after 2020 celebrating a new kind of growth. Instead of chasing ever higher sales volumes, the industry leaned into what analysts call pricing power. The idea was simple: raise sticker prices on flagship bags, shoes, and accessories, and let the brand's aura do the rest. Between 2020 and 2023, this approach played out across the sector. At Chanel, the price of a classic flat bag climbed by nearly 40% in less than 3 years. Louis Vuitton and Dior moved in lockstep, with double-digit increases on their most recognizable leather goods. For many models, a bag that cost $4,000 in 2019 was selling for well over $5,500 by 2023. Consultants at Bain & Company described this as a deliberate shift. Brands were no longer focused on selling more units. They were extracting more revenue from each sale. Executives praised this strategy in earnings calls, pointing to record profits and the ability to protect brand equity through higher prices. In 2022, Cassie Thorpe and other analysts noted that some houses had hiked prices as much as 25% in just 2 years. The logic held as long as buyers kept up. At first, they did, especially in the post-pandemic surge, when pent-up demand and easy money made luxury feel bulletproof. But these price moves were not just about inflation or currency swings. They were a conscious bet that customers would accept higher costs as proof of exclusivity. Board presentations celebrated pricing power that let brands outpace not only inflation, but also the broader fashion market. Some brands even framed price hikes as a way to elevate their clientele, making entry-level products less accessible and reinforcing the idea of luxury as a rarefied club. Behind the scenes, this approach drove revenue growth even as unit sales slowed. In 2022, luxury sector reports showed that price increases contributed more to top-line gains than any real expansion in volume. The strategy worked until it did not. As the numbers rose, so did frustration among younger and aspirational shoppers. By late 2023, the cracks were becoming hard to ignore. But at the height of the price surge, the industry was convinced that pricing power alone could sustain its mystique. By early 2025, the mood among younger luxury shoppers had changed. After years of chasing the latest it bag or limited edition sneaker, many ages 25 to 34 began to reconsider. The sticker shock was real. A Chanel classic flap that once seemed just within reach now cost more than a used car. Across the U.S., data from Consumer Edge showed that spending on single-brand luxury fell 6% year over year. The drop was even steeper on multi-brand platforms, down 22%, but the numbers only tell part of the story. This pullback was sharpest among the so-called aspirational buyers, the very customers luxury houses had counted on to fuel growth. For this group, apparel, footwear, and accessory purchases fell by 6.2% over 12 months. These shoppers weren't just buying less, they were pausing, weighing their options, and often deciding to wait. The appeal of full-price luxury faded as prices rose faster than incomes. Instead, many turned to the resale market or opted for contemporary brands that offered a similar look at a lower price point. Brand consideration surveys tracked the shift in real time. According to YouGov Brand Index, consideration for 8 leading luxury names, including Burberry, Dior, Gucci, Louis Vuitton, and Prada, dropped nearly 25% in the US between January and April 2025. Non-luxury fashion brands, by contrast, held steady. The message was clear: the pool of shoppers thinking seriously about a luxury purchase was shrinking fast. The reasons varied. Some cited frustration with relentless price hikes and a sense that entry-level products no longer felt special. Others pointed to a lack of product innovation or simply felt squeezed by higher living costs. But for many, the calculation was practical. Why pay full price when the same bag might show up at a discount a few months later or on a resale platform for hundreds less? As prices shot up, the promise of luxury as an investment started to look shaky. This measured withdrawal had consequences beyond the sales floor. When aspirational buyers step back, unsold inventory begins to pile up. The bags, shoes, and ready-to-wear that once moved briskly now linger in stockrooms and on shelves. Brands that once prided themselves on scarcity found themselves managing excess. The quiet retreat of these younger shoppers set off a chain reaction, one that would soon force luxury houses to rethink how and where they sold their goods. Boxes of unsold handbags and stacks of last season's shoes now linger in stockrooms that once turned over merchandise in a matter of weeks. For luxury operations teams, the numbers tell the story. At Kering, the group behind Gucci and Saint Laurent, inventory climbed from €3.68 billion in 2022 to €4.17 billion in 2023, a 13% increase in just 12 months. When measured against the cost of goods sold, that means Kering held about 184 days of inventory in 2023, up from 178 days the year before. That is roughly 6 months of product sitting before it finds a buyer, a clear sign that goods are moving more slowly through the system. LVMH, the world's largest luxury group, faced a similar trend. Total inventory rose from €22.7 billion to €24.6 billion between 2022 and 2023, an 8% jump. Group-wide, that translated to 187 days of inventory on hand, just over 6 months, compared to 181 days the previous year. Even for a diversified giant, that is a meaningful extension, especially as growth in major categories like fashion and jewelry cooled. Burberry, with its heavier reliance on seasonal fashion, confronted even starker numbers. By early 2024, the company reported nearly £1.3 billion in inventory, up 8% from the previous year. Calculated against cost of sales, Burberry's stock sat for nearly 296 days, close to 10 months, before selling, up from about 9 months the year prior. Management described inventory as elevated relative to demand and said they were actively reducing stock through outlets and markdowns. Prada's position was less acute but still notable. Inventory edged up 5% to €1.3 billion in 2023, leaving the group with about 260 days, 8 to 9 months of merchandise on hand. While management described the situation as under control, the numbers show that even well-managed brands are carrying more unsold product than they did during the boom years. Sector-wide, analysts at McKinsey and the Business of Fashion confirm that luxury inventory has been growing faster than sales since 2023, particularly in North America and Europe. The phrase elevated inventory levels appears repeatedly in reports and earnings calls, signaling a physical backlog that is difficult to ignore. For many brands, this means more product is quietly diverted to outlets, department store markdowns, and third-party clearance channels, all before the financial pressures of carrying these goods are even considered. These figures are calculated at the group level, including all categories from bags to ready-to-wear. While some inventory, like timeless leather goods or jewelry, can be held longer without risk, the direction is clear. Luxury's famed scarcity is being undermined by growing piles of unsold stock. Operations teams now face the challenge of moving this backlog without openly undermining the high-price aura that defines the industry. For luxury brands, holding unsold inventory is not just a matter of space. It is a financial drain that compounds with every passing month. When interest rates were near zero in 2020, the cost to finance $100 million worth of handbags, shoes, or ready-to-wear stock hovered around $1.4 million a year. By 2024, that same pile of inventory cost more than $4.3 million annually to finance because of a sector-wide jump in borrowing costs. For companies like Kering and LVMH, the average rate on short-term debt climbed from just over 1% to more than 4% between 2020 and 2024, tracking the broader surge in global interest rates. The math is stark. Each additional percentage point in interest rates means another $1 million a year in carrying costs for every $100 million in unsold goods. For a group sitting on $1 billion in inventory, the rate hikes since 2020 added nearly $30 million in annual costs. Even for cash-rich brands that do not borrow heavily, the hurdle rate, the opportunity cost of tying up capital in slow-moving stock, has risen in step with the market. Boardroom discussions now weigh the cost of waiting for full-price sales against the certainty of paying millions in interest and lost opportunity. This is not just an accounting headache. It changes day-to-day decisions. A chief financial officer looking at 6 months' worth of unsold product has to ask, is it smarter to clear stock through outlets or markdowns now, or to keep paying higher financing costs in hopes of a better price later? In 2020, a brand could afford to wait. Carrying costs were low, and the risk of deep discounting felt distant. By 2024, the calculus is different. The longer inventory sits, the more it eats into profit margins, and the less room there is for patience. The numbers play out across the sector. LVMH's interest expense more than doubled between 2020 and 2024, rising from 400 million euros to more than 1.1 billion euros, even as the group tried to manage inventory more tightly. Kering's interest costs jumped by a similar proportion. For middle-tier brands with thinner margins, the impact is even sharper. Every extra dollar spent on financing inventory is a dollar not invested in new product, marketing, or store upgrades. For luxury brands, the cost of carrying unsold goods is no longer a background worry. It is a frontline pressure. Higher rates have made it too expensive to let inventory linger. The financial logic now favors moving product out of stockrooms and into channels where it can be sold, even if that means accepting a lower price. This is the invisible force pushing more handbags, shoes, and accessories into outlets and markdown events, and it is one of the clearest reasons why discounting is spreading beneath the surface of the luxury market. Luxury brands rarely announce public sales, but transaction prices are quietly slipping through 4 main channels. Outlets play the most visible role. Once reserved for off-season or made-for-outlet stock, these stores now receive recent season bags, shoes, and ready-to-wear that did not sell at full price. Shoppers can find items that appeared in flagship boutiques just months earlier, often at discounts of 30 to 50%. Department stores use a different approach. Instead of bold clearance signs, they rely on loyalty promotions, private codes, and friends and family events. These targeted offers lower prices on luxury goods without damaging the brand's official image. Online, third-party retailers and e-commerce platforms compete for customers with limited-time promotions and site-wide discounts. High-end items are included more frequently, even if core icons are sometimes excluded. Finally, brands themselves conduct selective clearance, using private online archives, invitation-only sales, or tightly controlled events that quietly move excess stock. Each route keeps official list prices high while letting average transaction prices drift lower. The result is a widening gap between what is printed on the tag and what many shoppers actually pay, especially outside of flagship stores. Gucci's recent years tell a story through numbers and markdowns. By spring 2025, U.S. consumer interest in the brand dropped from 13.4% to 11.9% according to YouGov, while resale values for the Jackie bag slipped 25% as more inventory landed in outlets and department stores that quietly trimmed prices. Prada, facing its own slowdown, reported a 25% drop in brand consideration and turned to third-party promotions. Neiman Marcus offered select leather goods at 20% off as inventory levels rose. Burberry, after a run of price increases, introduced bags under $1,000 and saw its classic check coats discounted up to 40% at department stores, while outlet shelves filled with TB bags. Saint Laurent made a rare move in early 2024, cutting U.S. prices on the Lulu bag by 10%, a direct response to aspirational buyers stepping back. At Balenciaga, unsold stock from past creative directions is now expected to flow into outlets, with department store promotions accelerating as demand for high-volume streetwear fades. Fendi expanded its outlet presence, offering baguette bags at discounts as high as 50% and seeing resale values soften on platforms such as The Real. Coach, meanwhile, leaned heavily on its network of over 500 outlets, with Chief Executive Officer Joshua Schulman acknowledging that most new bags went straight to sale, often at 20 to 30% below list price. Each of these brands faces a distinct pressure point, but together they show how discounting and inventory management are reshaping the luxury market from the inside out. Resale markets now serve as a public scoreboard for the value of luxury goods. Since 2022, prices for many mid-tier designer bags have dropped by double digits on platforms like The Real and Vestiaire Collective. A Burberry TB bag that once sold for $1,800 in 2023 might fetch only $1,400 a year later. Balenciaga's Hourglass models, once hyped as status symbols, have seen resale values fall by more than 30% as discounted inventory floods outlets and third-party sites. Fendi's Peekaboo and Baguette bags, staples of the brand's image, are now regularly listed at 40 to 50% below retail on resale channels, tracking the same markdowns seen at outlets. Analysts who track these price swings point to a clear pattern. When shoppers see a bag discounted by 30% at an outlet, they anchor its worth to that lower number. The effect is self-reinforcing. Collectors and early adopters who once counted on bags as investments grow wary when resale values slide, and the next round of buyers becomes even more hesitant to pay full price. Yet there are exceptions. Bags with tightly controlled supply, like Hermes Birkins or Chanel's classic flap, continue to command premiums on the secondary market. Their owners rarely see deep discounts, and resale charts for these icons remain stable or even climb. This contrast highlights the growing divide between brands that protect scarcity and those that rely on volume. One group maintains its aura, while the other faces a steady erosion of value and status. Luxury's grip on status depends on scarcity, and that illusion fractures once discounts go mainstream. As outlets expand and resale prices fall, brands risk becoming ordinary labels in a crowded market. In 2024, the real luxury isn't in the logo, it's in what remains untouchable. The next era will belong to those who protect their mystique, not those chasing volume. What do you think? Has luxury lost its edge? Drop your thoughts below.